Hello everybody and welcome back to Make Money Now. Dividend investing is a strategy of buying stocks that pay dividend in order to receive a regular income from your investments. This income is in addition to any growth your portfolio experiences as the stock in it gains value. But before we get into that, welcome to our channel. Tap the red subscribe button down below and make sure you hit the like button as well, because that helped us reach more people like you that want to find out about these amazing apps. We would really appreciate that. Make sure you stay as you don't want to miss out on these amazing ways. What is dividend investing? Dividends are payments a corporation makes to shareholders. When you own stocks that pay dividends, you are receiving a share of the company profits. Dividend investing allows you to create a stream of income in addition to the growth in your portfolio's market value from asset appreciation. How dividend investing works. Buying stocks that pay dividends can reward you over time as long as you make intelligent buying choices. If the company you own shares of has a dividend investment plan, or DRIP, you can choose to have your dividends reinvested to buy additional shares rather than having them paid out as a profit. This is a useful strategy when your dividends are small, either because the company is growing or because you don't own much stock. Are dividends safe? Good dividend investors tend to look for dividend safety, or how likely it is that a company will continue to pay dividends at the same or higher rate. While there are companies that assess and rank dividend safety for different stocks, you can also begin to analyze a corporation's level of safety by comparing earnings to dividend payments. If a company earns $100 million and pays out $90 million in dividends, you'll make more than a profit than you would if only you pay $30 million in dividends. However, if it pays out $90 million and profits fall by 10%, the company won't be able to continue paying at the same high rate. This in turn reduces your income. The $30 million dividend payout also decreases in this scenario, but by a much lower percentage. Dividend safety is also determined by how risky or a new industry is. Even if a company has a low dividend payout ratio, your dividend payment is less safe if the industry is unstable. For instance, COVID-19 rendered industries like retail, airlines, and hotels unstable with consumer goods. Healthcare and technology become more stable choices. Look for companies that have a history of stable income and cash flow. The more stable the money coming in to cover the dividend, the higher the payout ratio can be. Strategies for dividend investing. Good dividend investors tend to focus on either a high dividend yield approach or a high dividend growth rate strategy. Both serve different roles in different portfolios. A high dividend yield strategy focuses on slow growing companies that have substantial cash flow. This allows them to fund large dividend payments and produces an immediate income. A high dividend growth rate safety strategy focuses on buying stock in companies that currently pay lower than average dividends but are growing fairly quickly. This allows investors to buy profitable stocks at a lower rate and make a large absolute dollar income over a 5 or 10 year period. Different dividend investors may prefer one strategy over another, depending on whether the goal is immediate, stable income, or long-term growth and profit. When choosing a strategy, determine what level of risk you prefer and how long you are willing to wait for your dividends to produce a substantial income. Tax benefits of dividend investing. Look for dividends that are designed as qualified to take advantage of tax benefits. Most income from dividends is based only on income. However, qualified dividend stocks held for a longer period of time, usually 60 days or more, are taxed at the lower capital gains tax rates. If you buy dividend stocks to get dividend payment and then want to sell them quickly, you'll have to pay your regular tax rate on the dividend income. The advantage to dividend investing versus investing in growth stock companies is that an economy that is flat or going down, you are able to take your dividend income and reinvest it to give you more shares while decreasing your cost basis and increasing your equity versus someone who holds onto growth stock that might just be going up and down but ultimately going nowhere in that same amount of time. The downside is that you pay more in taxes slightly over time, so there are advantages to both. There's a strong argument to be made for index fund investing to have better returns than dividend investors, but this is our personal favorite way of building wealth for passive income. How you can pursue dividend investing. If you'd like to start generating income with dividend investing, you might implement one of the following 3 strategies. Aim for high dividend yields. This is a classic strategy for dividend investing. The focus here would be on slow growing, establishing companies with a lot of cash flow that pay high dividends. These kind of investments make sense when you are looking to generate income right away. Just keep in mind that high yields aren't everything. The companies may not see as much growth in stock value as other companies with lower dividend yields. choose high dividend growth. Investors with a longer time horizon can focus on buying stock in companies that are growing rapidly but currently pay lower than the average dividends. This won't yield as much income in the short term, but as a firm grows and its business matures, the dividend yield should rise gradually. Getting in early means investors can buy more shares and eventually earn more dividends. The cheaper cost on yield makes this a better long-term investment strategy. Pursue dividend capture. Dividend capture is a more active, hands-on approach to harvesting dividend income. With dividend capture, it's not necessary to hold shares of a company for a whole year or an entire quarter to earn the dividend. Instead, you sweep in and buy them right before the dividend is paid out. Then, once you're paid, you sell them again so you're able to buy other stocks. But this isn't as easy as it sounds. To earn a quarterly or annual dividend payment, you must own a stock before the ex-dividend date, which is typically 2 weeks before the dividend is paid. Then, after the dividend is paid, you have to decide when to sell. This gets complicated and risky because share prices are volatile and may be lower once the dividend is paid than when you bought them. Share price declines like this can easily wipe out money you earned from the dividend or more. And even if your shares increase in value, if you're not trading in tax-advantaged retirement account, dividend capture can generate short-term capital gains that are taxed at the higher regular income rate. Risks of dividend investing. Every investing strategy involves risks, and dividend investing is no exception. The biggest risk is that dividends are never guaranteed. Companies can reduce and even eliminate their dividends. During the COVID-19 pandemic, some very prominent old guard stocks have done so. Wells Fargo, Dick's Sporting Goods, Carnival, Goodyear Tire and Rubber, HSBC, Airbus and Rolls-Royce, to name a few. But there are more subtle risks. Diversification should always be top of mind for any investor, and someone who focuses too much on dividends is likely to ignore some sectors and classes of companies they need for good diversification. Young, fast-growing tech companies, for example, don't generally pay dividends. Lack of diversification always exposes investors to increased volatility. Dividend-only investors can miss out on high-value growth in these sectors that might not be paying dividends or that pay uncompetitive dividends. In conclusion, passive income dividends provide a steady flow of passive income, which you can choose to spend or reinvest. This attribute makes dividend stocks particularly attractive to retirees looking to score some supplemental income. More stable companies that pay dividends, tend to be more mature and stable than companies that don't. Startups rarely pay dividends because they plow back all the profits to fuel their growth. Only when the company has attained a substantial level of success does its board of directors vote to pay dividends. In addition, the need to pay dividends tend to make the management more accountable to shareholders and less prone to taking foolish risks. Reduce risk. Because dividends give investors 2 ways to realize a return on their investment, they tend to have a lower risk to reward ratio, which you can see in less volatility in the share price. A stock with lower volatility sees smaller share price declines when the market falls. Low volatility may also temper share prices appreciations on the way up. If you enjoyed this video, make sure you go ahead and leave a like down below. That would really help us out in YouTube's algorithm. We would really appreciate that. That's pretty much it, guys. Don't forget to leave a like, subscribe. If you're new, turn on the post notifications, and then we will send you a message every time we come out with a new video, just like this one, for money to come online. So make sure you go do that and then enjoy your day.